Hello, dear audience, how are you? Today we are going to discuss about loan amortization, its application and treatments. Many of us took loans from the banks. Suppose if you go to bank, if you ask that I need $1 lakh US dollar for 5 years, what happens? The bank manager will say, okay, no problem, guys. I will give you a loan of 1 lakh for 5 years, and you have to pay me. Suppose 5,000 US dollar monthly, etc., etc. Well, how do you calculate generally? Okay, I've been taking a loan of 1 lakh and giving 5,000 installment, no more than this. But in business, we have to calculate something more. That's why today we have come here to discuss about this one. First of all, we will try our level best to give you actually what is loan amortization. We know loan amortization is the process of gradually paying off a loan over time through regular scheduled payments. Each payment you make is split into two parts. Okay, here principal amount as well as interest amount. We don't bother about the principal amount because we know we took a loan and we have to pay it off. But we bother of interest because how much interest bank charge to use this loan. It sometimes it's a headache. So we have to be very careful. So if you don't know how to calculate it properly, it's a big problem for all of us. Over the life of a loan, what happens? The interest portion decreases and the principal portion increases with each payment, and this continue until the loan is fully paid off. Today, we will learn how to calculate a loan amortization schedule actually, and we'll see how it helps, and we'll learn this with a demonstration problem. It will definitely help in our personal life as well. Let's go to loan amortization schedule. If we think Mr. David Watson is a person, he wants to take a property loan, suppose 4 lakh US dollar. He wants to take the loan from Citibank. You have to pay the loan in 30 years because it's not a very small amount. Bank telling me you have to pay 5% annual interest. What happens? Mr. David Watson is a businessman. He wants to calculate what is happening with his loan. It is called loan amortization. Whenever you would like to calculate a loan amortization, then first of all you have to calculate the maturity. Maturity here is 30 years, and 30 years means how many months? Number of payment will be 30 into 12 is equal to 360. Okay, 360. What will be the principal amount? 4 lakhs US dollar. Bank told you that you have to pay 5% interest monthly. Then how many months? We know 360 months. What will be the monthly rate then? Just what we will do, 5% is annually. So we will divide the annual interest rate divided by total number of months in a year. What happens then? What will be the EMI? What will be the installment size? Now let's calculate. Monthly payment, we have already calculated this one. Now the question comes to your mind, how this come up? For your simplicity, we just would like to show you a formula. It is in finance, it is called PMT function. Is equal to PMT. Just we give the first bracket. It is asking me what is the rate. So rate we have already calculated monthly rate is 0.42%. Okay, to give it. Then we are being asked how many times. or number of payments actually. Number of payments. We know we want to pay the loan in 360 months. 360 months. So we give 360 months. What is bank is paying you currently now? Bank is paying you 4 lakhs US dollar. Okay, 4 lakhs. Okay, fine. Uh, there is no future value because we have to pay the installment. So we will keep the future value is zero, and definitely we will want to pay the loan at the end of the month. So it is also zero. Okay, but as we are going, as we are going, uh, as we are going to take a loan, so it's a deduction, right? It's a deduction. So present value will be in minus formula. Okay. Now let's see what happens. Okay, we got the result. This is our installment size per month. Okay, we have to pay this 2,147 US dollar every month over the life of the loan up to 360 months. Okay, now what happens or what is its impact? We have to think like a businessman. Uh, we will calculate in Excel. Okay, first of all, what we have given, just look at this 360 months time. What is happening to my loan up to 360 month? 360 month. Okay, okay. Let me freeze you for your simplicity. Just wait a minute. Okay, fine. And in which date we have to pay, or which date we took the loan? Suppose we took the loan 112 2025 indicates in this day bank is giving me or disbursing the loan is very fine, and the month indicate over every year which month uh, what is the remaining loan size. What is the remaining loan size? It indicates look at the principal amount, interest, payment, principal paid, closing balance. Okay, fine. What does this row indicate actually? Principal means I think you can recall that bank gave us 4 lakh US dollars on 1 on 2025. So in January month, what happens? Bank told us that you have to give me installment every month 2,147 taka, okay, or and US dollar. Fine. They don't tell me what is the interest and what is the principal paid, but we have calculated it because it will helps our understanding very easy. Okay. Uh, at the end of January month, we are giving bank 2,147 and 29 of these 2,147 and 29, 1,667 is our interest amount and principal amount is 480.62. We are paying off this amount, and after that our closing balance stands to 3099 3 3,099,519. Okay, now what happens? This closing balance will come to the next month. Our principal, you look at the principal every month, principal is reducing. Okay, interest is also reducing, but principal amount paid is also increasing, and this is our closing balance. It is also reducing as we are paying off the loans every month. But our EMI size is always same. What happens? We can have an idea. Everybody has an idea. Actually, what is the outstanding figure of my loan in January month, in February month, in March, or when it will be over? Just look at this. We have already paying. Uh, if we take it as an example, in 2027, in the 29 months, our principal amount was 3,85,758. Okay, and our closing balance was 3,85,218. So it is reducing. We all can also watch it is reducing. What happens at the end of uh, 30 years? At the end of 30 years, what we can see, we have paid the bank in terms of interest 373,023 US dollars. We took the bank from 4 lakhs. We paid the interest 373,023. Total we paid 773,023 dollar US dollar. Means almost, you know, not a small sum. It's also a big sum. It helps our understanding whether taking the loan from this bank will be suitable for me or not. Hopefully, you had a much better idea about loan amortization. You have understand. For your benefit, I just give you a little help how we calculated this one. Actually, our principal was 4 lakhs. Okay, 4 lakhs. Okay. How do we calculate the interest? Because our monthly interest is 0.42%. So we have multiplied 4 lakhs into 0.42%. This one, look at this figure. And our monthly installment size was 2147. As interest is 1667, if we deduct from the payment, the principal amount stand 480.62. Okay. And the closing figures stand 399,519. Okay. What we have done, just from payment amount, we have minus the interest amount, we got principal amount, and how we got the closing balance, just from the principal amount, we have deducted the principal we paid. It scans to closing balance, and we have already calculated. So I think it will not be a tough case from you for your business to calculate the loan amortization. But it is not only loan amortization; it has some more uses. Now we have to see what is your accounting treatment and how it impacts uh, in different accounting software. We will see from the next series how do we post it in journal, how do we post it in ledger, how do we post it in trial balance, how do we post it in balance sheet, how do we post in income statement, and how also we manage these loaning accounting software like Xero, like QuickBooks, which help our understanding much more. So for today, no more. I just request you please stay tuned. Definitely, we can have a better learning about loan amortization throughout the series. This is series number 1. So hopefully it will help you. Thank you very much. Please stay with me. Thank you.